The myth of the American housing market is finally freezing over. For years, we were told real estate only goes up, that it was a foolproof investment, the ultimate safe haven against inflation and economic instability. That was a lie. The financial gravity that governs all asset classes has returned, and it is hitting the most overinflated, overhyped, and overleveraged markets in the country with the force of a wrecking ball. This winter, the economic chill is turning into a full-blown Arctic crash. We are entering a seller's nightmare, a moment where high mortgage rates, collapsing demand, and massive shadow inventory are coming together in a perfect storm that will leave hundreds of thousands of recent buyers facing deep negative equity. The question is no longer if the market will correct, but where the correction will hit hardest and how deep the cuts will be. For the patient, for those who refuse to be swept up in the frenzy of 2021 and 2022, this winter represents the single greatest opportunity of the decade. For those who stretched every last penny, who bought at the peak with adjustable rate mortgages, who believed the hype, this is the final, brutal warning. Today we are pulling back the curtain on the industry lies and exposing the cold, hard numbers. We've analyzed the data, looking for the telltale signs. Inventory spikes, soaring days on market, and the percentage of listings cutting their price. We are going beyond the headlines to identify the structural failures that will cause prices to slide by 10, 15, and even 20% in specific cities. We are exposing the 12 housing markets that will shock you with price drops this winter. Do not buy here yet. Before we dive into the list, you need to understand the three structural forces, the three killers, driving this winter freeze because they affect these 12 markets disproportionately. Killer 1. The rate wall and the affordability death sentence. The 30-year fixed mortgage rate, stuck near the 7% mark, has not just made housing expensive, it has made it financially impossible for an entire generation. The payment on a medium-priced home in a former boom city is now 40% higher than it was just a few years ago. Buyers have simply tapped out. The math is broken. An average family earning $100,000 cannot possibly afford a $700,000 house with a $5,000 monthly payment. This isn't a temporary delay. It's a permanent shift in demand that is pricing out everyone except all cash buyers. And that high net worth segment is also slowing down, waiting for the inevitable discount. The affordability death sentence means there is no floor beneath prices until either rates fall dramatically or prices crash dramatically. Based on Fed projections, we are betting on the crash. Killer 2. The inventory flood and the builders' panic. During the frenzy, builders went on an aggressive, debt-fueled construction spree, particularly in the Sunbelt. Now, those massive communities of new homes, the so-called production homes, are finished and sitting empty. This is creating a massive supply glut that is not reflected in traditional, existing home inventory reports. New home sales are being propped up by desperate builder incentives like rate buy-downs and free upgrades, but these are just a hidden price cut, and they are now dragging the entire market down. The builders' panic is real, and their price slashing is forcing existing homeowners to compete, accelerating the race to the bottom. This hidden inventory is the fuel for the coming price drops. Killer 3. The desperate seller and the end of FOMO. Nearly 35% of all listings nationwide are already slashing their price. But in the 12 vulnerable markets we are about to reveal, that number is closer to 50%. Who are these sellers? They are the accidental landlords who bought in 2021 hoping to flip or rent. They are the people who moved for a remote job that is now hybrid or terminated. They are the early investors who see the writing on the wall. They are desperate to liquidate, and their fear is palpable. The fear of missing out, FOMO, has been replaced by the fear of being left holding the bag, FOHB. The gridlock is breaking, the panic is starting, and the deepest price cuts are coming this winter. Let's start the countdown at number 12 and work our way toward the most dangerous housing market in America. Number 12. Dallas, Texas, the megacity oversupply crisis. Dallas built its way into a crisis. The sheer volume of new construction, massive, debt-funded developments stretching for miles outside the core, has drowned the market in supply. The city was hailed as the future of American urbanism, an engine of corporate relocation, but the boom was built on a foundation of cheap debt and the false promise of infinite, instantaneous growth. The reality is that the new inventory, from townhomes in Frisco to single-family subdivisions in Prosper, is through the roof. The high-end condos in the city's center are also sitting empty, suffering from commercial office vacancy rates that are among the highest in the country. The 30% price cut that builders are offering on their excess new inventory is now acting as a hidden, massive discount for the entire metro area, dragging the prices of all existing homes down with them. The data is clear and it's terrifying. Inventory is up 60% year over year. Median list price has fallen slightly, only 1.4% according to official reports, but do not be fooled. That number is suppressed by builders trying to protect their book value. Once the winter panic sets in and cash becomes king, look for that median number to hit a visible, undeniable -8% by Q1 2026. The Dallas promise is fading, and the market is about to get brutally cheap. Number 11. Las Vegas, Nevada, the investor liquidation event. Las Vegas is not a normal market. It's a casino for real estate investors. Its entire economy, and by extension its housing market, relies on tourism, conference traffic, and a constant influx of out-of-state speculative capital. The Vegas market relies on out-of-state money and short-term rentals, and both are collapsing simultaneously. The double whammy of a national travel slowdown and the introduction of new Airbnb restrictions and high HOA fees has made investment property here a money pit for investors. Short-term rental earnings are collapsing. Cash flow is turning negative, and investors who bought second and third homes are now racing to the exit. When institutional or speculative investors panic, they don't list their property, they dump them. This is not a slow, gentle correction, it's a liquidation event. The urgency is evident in the data. 45% of all listings in Vegas have seen a price reduction. The average days on market is now comfortably over 60, a red flag warning sign. This winter, watch the investor flight turn into a full-scale stampede. Number 10. San Antonio, Texas. The wage stagnation trap. San Antonio offers a critical lesson in why you must always compare home prices to local wages. San Antonio's median home price jumped far faster than local wages could ever support. It was a massive dislocation between asset prices and the actual earning power of the residents. The affordability wall has been hit hard. The local economy, dependent on military bases, healthcare, and services, simply doesn't generate the massive tech salaries seen in Austin. Low-income buyers are absolutely priced out, and the speculative investor crowd who were banking on Bay Area transplants driving up prices forever have dried up. The affordability gap here is more of a yawning chasm. The data confirms the disaster. Official prices are down 2%, which seems modest, but the average San Antonio family now spends over 40% of their income on housing. When you cross that 40% threshold, the debt becomes suffocating. That is a formula for financial suicide that the market must eventually correct through mass price cuts. San Antonio will be a slow, painful bleed this winter.
We now move into the core of the crisis, examining markets where the structural problems go beyond mere affordability and interest rates. These are cities facing environmental collapse, regulatory backlash, and a complete reversal of their supposed growth narratives. The price drops here will be not just financial, but existential, punishing buyers who fail to recognize that a home is a long-term liability, not just an asset. Number 9. Tampa, Florida, the insurance nightmare trap. Tampa was a top migration spot for both snowbirds and young professionals fleeing the Northeast. But the floodgates of migration have slammed shut due to one simple, insidious cost: insurance. The reality of climate risk, hurricanes, floods, and persistent storm damage has finally hit the banking and insurance sectors, and they are pulling out or pricing the risk impossibly high. The 40% jump in home insurance premiums is a hidden cost that is now killing deals at the closing table. Suddenly, that low property tax and the promise of a cheap Florida life doesn't matter when your annual insurance bill is $7,000, or worse, your current carrier refuses to renew, leaving you scrambling for coverage on the last resort state-backed plan. Buyers' monthly housing payments are no longer determined by the mortgage rate alone, but by the rapidly inflating I&T of PTE, insurance and taxes. This crisis is making homes in high-risk areas toxic assets. The data confirms the panic. Price cuts are hitting 33% of listings, particularly those in older, higher-risk zones. Flood-zone homes are now toxic assets, and this winter, the cost of coverage will drive prices down further than any rate hike could. The Florida dream is becoming an insurance nightmare. Number 8. Denver, Colorado, the tech retreat and suburban overreach. Denver was the darling of the Mountain West, a high-altitude beacon for the tech worker exodus from California and Seattle. The influx of high-earning, low-loyalty tech workers inflated prices far beyond the local wage capacity. Now the remote work honeymoon is over. Companies are demanding hybrid schedules, forcing many who relocated to sell and move back, or they are executing massive layoffs, killing the source of that high-end demand. The market is being hit by a wave of inventory from the suburbs where people bought large, expensive homes to accommodate full-time remote work. As companies consolidate, the expensive suburbs like Castle Rock and Parker are facing a glut of inventory that the remaining local buyers simply cannot absorb. This is a classic case of demand disappearing while inventory surges. The price drops are already hitting the middle and high end, and it's flowing down. The data shows price drops are hitting 35% of homes across the metro area. Watch out for the downtown condo market to tilt first, as the combination of high cost, high taxes, and a struggling downtown core makes urban living less appealing to the few workers who remain. Denver is retreating back to reality, and it's going to be painful for recent buyers. Number 7. Boise, Idaho, the bubble that burst first. If you want a crystal ball for the other 11 markets on this list, look at Boise. Boise saw one of the biggest pandemic price spikes in the country, with home values doubling in an astonishing 3 years. That growth was completely unsustainable, fueled entirely by desperate California equity fleeing the coasts. This was not organic growth. It was a speculative frenzy driven by fear. Now the music has stopped. The migration has slowed to a trickle, and the local market is adjusting to reality. The market is drowning in the inventory that the pandemic buyers purchased. The problem is that the local job market simply does not generate the wages necessary to support a median price over $500,000. The only reason homes sold at those prices was the influx of cash. With that cash gone, the market has no floor. The data tells the entire story of the collapse. Inventory is up 75% compared to its pre-pandemic levels. Prices are still falling, having already corrected sharply from the peak, with a strong forecasted minus 10% correction on the median price by spring. The panic is real, and the discounts are steep. Boise teaches us a cruel lesson. Speculative booms always end in busts. Number 6. Jacksonville, Florida, the investor liquidation strategy. Jacksonville, like Tampa, benefited from the Florida migration, but faces a specific, targeted threat: high institutional investor concentration. Jacksonville saw heavy institutional investor presence and speculative flipping. They drove up prices and rents, creating an artificial market. These institutional and private equity firms don't feel emotional pain. They are cold, calculating cash flow machines. When the cash flow turns negative, which it has due to rising insurance costs, higher vacancy rates, and higher taxes, they execute a cold-blooded liquidation strategy. They're quietly selling off portfolios in bulk due to softening rents and rising costs. This market is highly vulnerable to a mass liquidation event where thousands of homes hit the market simultaneously, overwhelming buyer demand and annihilating price stability. The fear is that these large corporate owners will dump properties at a deep discount just to clear their books, setting a new, terrifying precedent for the actual median price. The urgency is undeniable. Investor ownership is one of the highest in the country, and 41% of all existing sellers are cutting prices, trying to beat the institutional sell-off. This winter, Jacksonville will be the battleground between panic-selling individuals and cold, cash flow-driven corporations. The individuals will lose. These 4 cities, Tampa, Denver, Boise, and Jacksonville, demonstrate the multifaceted nature of the housing crash: environmental risk, corporate retreat, speculative bubble bursting, and investor panic. All 4 share a common thread. Their price gains were fundamentally detached from local economic reality. They were fueled by external capital that is now retreating, leaving the local market to absorb the fallout. The buyer waiting on the sidelines has the ultimate leverage, knowing that this inventory must be cleared before the next spring market can even begin to materialize. The price cuts are not a concession, they are a forced surrender. The warning signs are no longer signs, they are active red flags waving over a collapsing financial landscape. If you are an investor, these are the markets you short. If you are a buyer, these are the markets where you prepare your lowball offer. We now enter the territory of the deeply vulnerable, major metropolitan anchors whose internal and external pressures have converged to create an inescapable downward trajectory for home prices. These are not just markets correcting speculative overshoots. These are cities where core functional failures, from environmental stability to public safety and regulatory overreach, are actively destroying home values. The price drops here will be permanent, marking a fundamental repricing of risk and desirability that buyers cannot ignore. Prepare to see the fragility of supposed economic powerhouses revealed. Number 5. Atlanta, Georgia. The urban exodus and tax burnout. Atlanta was sold as the economic capital of the New South, a magnet for corporate headquarters and young professionals. While Atlanta's job market remains robust, a critical shift is underway that is quietly destroying value in the most desirable areas. The relentless rise of property taxes and the increasing pressure of urban decay and crime. The market is being hit by a wave of affluent residents trading their high tax bills for perceived safety and lower costs outside the core. High property taxes, combined with stagnant or slightly falling home prices, mean homeowners are experiencing a relentless squeeze on their net worth. Unlike cities where a price jump offsets the tax hike, Atlanta's current environment forces homeowners into a double bind. Their costs are rising, even as their equity stops growing or starts to shrink. The inner-city condo market and transitional neighborhoods are seeing the brunt of this panic, suffering from high vacancy rates and declining rental incomes. This is not a tech layoff problem, it's a quality of life and cost of governance problem. The data confirms the exodus. The inner-city condo market is already suffering losses in the range of 5 to 10% on original purchase price for units bought in the last 3 years. The overall market is masking this decline, but the trend is clear. People are paying a premium to get out of the city's gravitational pull. The Atlanta promise is running into the immovable reality of taxation and public safety. Number 4. Nashville, Tennessee. The Airbnb saturation bomb. Nashville's massive growth was fueled by two things: country music tourism and short-term rental investment. The downtown core became entirely saturated with condos and homes bought specifically for Airbnb income, creating an ecosystem highly sensitive to travel trends and local regulation. The bubble is now popping. New regulations have severely restricted where short-term rentals can operate, and the post-pandemic surge in tourism has leveled off, meaning the high returns investors were banking on are now completely gone. Investors who bought units for $500,000 to $800,000 are suddenly facing negative cash flow because their properties are legally constrained or simply sitting empty. The response is predictable. Investors are being forced to choose between massive discounts for a quick cash sale or converting their units to long-term rentals, which floods the traditional rental market and further depresses property values. The pain is localized but extreme. The median days on market for a downtown condo has doubled in the last year, a clear sign that the buyer demand has vanished. This winter, watch for the inevitable wave of distressed Airbnb investors deciding to cut their losses and sell at whatever price they can get. This liquidation will set a terrifying new pricing floor for the entire Nashville metro.
Number 2. Orlando, Florida, the Mouse House meltdown. Orlando, the theme park capital of the world, is experiencing a sharp, swift decline driven by the collapse of two core pillars: tourism volume and investor speculation. The post-pandemic surge in tourism, fueled by pent-up demand, is finished. Now, consumers, squeezed by inflation, are cutting back on expensive trips to Disney and Universal. This is hurting the local job market and, critically, the rental market. Like Nashville, Orlando became saturated with investors buying homes specifically for vacation rentals. The sudden drop in tourism and a local crackdown on non-compliant STRs means these investors are bleeding cash. The situation is exacerbated by new apartment construction, which is putting downward pressure on rents, forcing investment properties into negative cash flow territory. The market is facing a wave of forced conversions of high-end vacation homes into long-term rentals, crushing rent prices and signaling the buyers that Orlando's rental income stability is non-existent. The urgency is visible on the streets and in the data. Inventory is near a 10-year high, and 38% of sellers are actively slashing prices. Orlando is a prime example of a market built on optimism and external capital. When that optimism evaporates, there is nothing left to hold prices up. These markets, from the urban complexity of Atlanta to the ecological crisis in Phoenix, demonstrate that the housing crash is not a uniform event. It is a series of targeted, surgical strikes against markets with specific, fatal weaknesses. The buyer who understands these weaknesses gains immediate, massive leverage. The current homeowners in these areas are being forced to pay the price for years of unbridled speculation and willful blindness to risk. The clock is ticking, and this winter, the desperation will turn into a full-scale rout. We have reached the epicenter of the crisis, the ultimate embodiment of the irrational exuberance that defined the pandemic housing market. This is the city that will serve as the national poster child for the coming crash, a cautionary tale taught in business schools for the next 2 decades. This city's fall is not a correction. It is a profound, violent reversal that will reset its valuation to a pre-boom basement level. Its massive surge was not a sign of fundamental strength, but the most egregious speculative bubble in modern American history. Number 1. Austin, Texas, the hubris of the bubble. Austin was the most overhyped, overvalued market in America. It was the destination for every fleeing Californian, the promised land for every venture capital dollar, and the ultimate symbol of the new decentralized tech economy. Prices here rose over 60% in just 2 years, completely detaching the cost of housing from local income, historical norms, and global sanity. That massive inflation was predicated on 2 fragile pillars: the belief in infinite tech sector growth and the guarantee of cheap money. Both have spectacularly collapsed. Now the twin evils of massive tech layoffs at companies that anchor the city's economy and the 7% mortgage rate are hammering the city. The inventory flood in Austin is historic. The surrounding suburbs and high-density developments, fueled by that brief, frenzied migration, are now sitting empty. The high-value homes, the million-dollar-plus properties, are failing to attract buyers, forcing dramatic price reductions that are cascading down the entire value chain. The data confirms the scale of the disaster. Austin is already down 5% from its peak. But unlike other cities that might find a floor, the distance between Austin's current price and its pre-pandemic valuation is simply too vast. Experts predict a total correction of 15 to 20% before the market finds a stable floor. This is not a guess. This is a certainty born from fundamental market gravity. For those who waited, Austin will become the cheapest it has been in a decade. For those who bought at the peak, their equity has evaporated and their principal is next. The Austin dream has imploded, leaving behind a market defined by desperation and deep discounts.
The 5 rules of survival. How to win during the crash. The time for speculation is over. The time for action is now. Whether you are a buyer preparing for your once-in-a-lifetime opportunity or a homeowner desperately trying to protect your wealth, you need a strategy. This crash will not be survivable for those who freeze. It will reward those who act with cold-blooded calculation. Here are the first 2 of the 5 rules of survival, designed to guide your financial decisions through the coming market collapse. Rule 1. Cash is king. Build the war chest. Forget the myth of buying now or being priced out forever. That narrative is dead, killed by the 7% mortgage rate. Your priority today must be liquidity. Cash is the only leverage you have in a collapsing market. It eliminates the mortgage rate problem
And it allows you to bypass the desperate, time-constrained seller who cannot afford to wait. You must treat every dollar saved this winter as a dollar of future discount. If you are a prospective buyer, stop the aggressive renovations, delay the new car purchase, and ruthlessly cut all discretionary spending. Your goal is to accumulate enough cash to put at least 30% down, or ideally, buy all cash. Why 30%? Because in a falling market, a large down payment shields you from immediately going underwater on your mortgage and allows you to access better financing options when banks tighten lending standards, which they will. The buyer with cash in hand in Q2 2026 will command a premium discount in any of the 12 markets we've listed. If you're a current homeowner, you must focus on building a massive emergency fund. Banks are going to get nervous, job markets are going to contract, and you need a liquidity buffer to avoid being one of the forced sellers. A forced sale into a down market is financial annihilation. Protect your cash flow at all costs. Rule 2. Master the shadow inventory. Bypass the realtor lie. The official listings you see on Zillow and Redfin are a carefully curated lie. They represent the advertised market, which realtors and sellers are desperately trying to protect from panic. The true opportunity lies in the shadow inventory. This inventory consists of homes that are officially withdrawn, temporarily off-market, or that are simply being rented out by desperate owners who tried and failed to sell at the peak price. Realtors advise sellers to take the home off the market after a few weeks to reset the clock, avoiding the public stigma of days on market reaching 100 or 150. These sellers are the most desperate because they have failed to sell at their desired price and their holding costs are mounting. Your strategy must be to bypass the public listing and target the shadow inventory directly. Use tools that track expired and withdrawn listings. Send personalized, handwritten letters to homeowners in the neighborhoods you want to buy into, specifically targeting homes that have been on and off the market several times in the past year. This is a direct approach that cuts out the agent's inflated commission and lands your offer, a guaranteed quick cash closing, directly on the seller's kitchen table. In a high-anxiety market, the guarantee of a clean, swift closing at a discount often beats a higher contingent offer. You must become a shadow market predator, hunting the distressed inventory that the industry tries to hide. We will detail the remaining 3 crucial rules for surviving the housing crash in the final section, focusing on how to negotiate and where to invest the money you save by following these rules. The final phase of the crash is about to begin. The crisis is escalating, and those who remain passive will lose their shirts. To transition from a vulnerable spectator to a market victor, you must adopt the final 3 rules of survival, leveraging the desperation of sellers against their collapsing prices. These are the tactics of market predators, designed to extract maximum discount during the winter of the housing crash. Rule 3. Negotiate the PITI, the hidden discount. In the 12 volatile markets we detailed, the most overlooked cost component is PITI, principal, interest, taxes, and insurance. While the seller cannot change the interest rate, they are highly motivated to offset the buyer's monthly pain. Your negotiation must center on the T and the I. Demand that the seller buy down your mortgage rate 1 to 2 points, effectively covering the interest pain. More importantly, focus on the property tax assessment. When prices fall, taxes are slow to follow. Negotiate a credit at closing large enough to cover the first year's property tax, giving you time to immediately appeal the assessment with the county to reflect the new lower purchase price. Similarly, for insurance, demand the seller pay for a full year of insurance premium in advance, especially in high-risk markets like Tampa and Orlando. By forcing the seller to address the PITI problem, you're securing a hidden, massive discount that compounds every month. The desperation is your leverage. Use it to attack the entire cost structure, not just the sale price. Rule 4. Prioritize defensive assets, the cash flow shield. During a market correction, the goal shifts from seeking appreciation to securing cash flow. Speculative bets on price gains are financial suicide. The only safe real estate investment during a crash is property that generates reliable income. If you're buying, focus on defensive assets. Duplexes, triplexes, or single-family homes in neighborhoods with high, sustainable rental demand, like near military bases, hospitals, or major universities. These renters are recession-proof, and the stability of the rental income acts as a shield against falling home values. Your property may lose value on paper, but if the cash flow is strong, you can wait out the crash. Defensive assets over speculative trophies. This strategy protects your principal and provides the necessary liquidity to pounce on further distressed deals when they arrive. Rule 5. When to buy. The 100-day rule. Forget the realtor's advice about bidding wars. You will only buy a home when its listing has exceeded 100 days on the market, and ideally 120 days. When a listing crosses the 100-day threshold, the psychological pressure on the seller becomes immense. It signals to the bank, to their neighbors, and most importantly to them that their price expectations are fundamentally wrong. It is at this point that desperation peaks, and they become amenable to offers of 15 to 20% below asking price. Combine the 100-day rule with a low-ball offer and a clean, all-cash or large down payment closing, and you will secure the deepest discounts. The seller who has been sitting for 4 months is your ideal target. Patience is your multi-million-dollar asset. The clock is ticking. The winter of the housing market is not just a slowdown. It is a financial reckoning that will create vast chasms between the prepared and the panicked. The price drops are coming to Austin, Phoenix, Tampa, and the other 9 markets we exposed. If you follow these 5 rules, you will not just survive the crash, you will use it to build wealth while others lose theirs. Do not be the last one holding the bag.